Non-current liabilities. So we just spoke about a current liability. Now we're looking at a non-current liability. What's the difference?
Non-current is more than 12 months.
Which is?
Long term. And then
Exactly.
Current is short term.
Correct. Okay, so non-current liabilities are going to be used to finance what? What will you use non-current liabilities for?
Bonds, loans.
For what? For what type of assets?
Liabilities.
No. Long-term loans for long-term assets. Okay, so you'll use a bond for what?
To get finance for your house.
Yes, okay, so a house would be considered what?
An asset.
A long-term asset. Okay, so why is a bond considered a long-term asset?
Because at the end of it, it's still yours.
Yes, and what happens with that asset? How long do you use the asset for?
As long as it is paid off for.
Okay, so do you agree a non-current asset is what?
Non-current asset is
An item that's normally tangible that lasts for a long period of time. Okay, so property, plant, and equipment. Tangible, intangible.
property that's intangible.
It's intangible? No.
It's tangible.
Yes, okay. Property, plant, and equipment is tangible. Land and buildings, machinery, equipment. Can we see those items? Can we move them around? Yes, okay, so that's all considered what? Tangible, non-current. Okay, so non-current assets are going to be financed with non-current liabilities. Okay, so you use long-term with long-term. You use short-term with short-term. Okay, you're not going to use a bank overdraft to buy a house.
No.
You're not going to use a credit card to buy a car.
No. Some people do that.
Why would you want to, though?
No, I wouldn't want to.
But I'm just, why shouldn't they do that, though?
Because they don't have the money to pay off.
Besides that, what sort of rate will you pay on the credit card?
Extremely high.
A lot higher than if you had to pay
Monthly.
vehicle and asset finance. Okay, so non-current is long-term financing, long-term assets. Okay, so financial position is determined by what? The difference between what?
The assets and the liabilities.
Which assets and which liabilities?
Non-current assets and non-current liabilities.
Okay, but it's financial position, so it's total assets and total liabilities. Right, companies require more assets and liabilities to avoid becoming
Liquidated.
yes, insolvent or bankrupt. Okay, so if liabilities are greater than assets, what position is the company in?
Sorry?
If liabilities are greater than assets, what position is the company in?
A bad position.
Correct. So is this company going to be a going concern?
Yes.
No. Okay, remember going concern is we will continue operating in the future. Okay, remember that was one of the...
Concern for the future. Okay.
Oh, okay, no. Going concern came from your characteristics.
Okay.
Alright, I don't know if you remember chapter 1 that well, but characteristics. One of the characteristics was, is the business a going concern? Going concern means, is the business going to continue to operate in the foreseeable future? Okay, that's what you're looking at. Alright, so will a company be a going concern if their liabilities exceed their assets? No. Okay, going concern means liabilities are greater than, no, other way around. Going concern means assets are greater than liabilities. Right, what's the definition? We spoke about it earlier. Will you have a different definition for a long-term asset? No. You'll have the same definition. The only thing different is the time frame. Okay, so how long do you actually have? Okay, that's the important bit. So greater than 12 months will be considered a non-current liability. Okay, the rule still applies. Credit plus. Okay. All right, we spoke about this. Insolvency or bankruptcy, not a going concern. Okay. Okay, going concern means you will continue operating in the foreseeable future. Okay. Alright, so I want you to think about these two groups, non-current account, because now we've looked at them both. Okay, we spoke about current being creditors, bank overdraft, and then we spoke about non-current being long-term loans, bonds, etc. Okay, so which liability is considered more, inverted commas, risky? There's pros and cons to both.
The non-current.
Okay, so tell me about the non-current. Give me some pros and cons.
It will be a higher interest rate.
Will it? Non-current.
Yeah.
So you would pay a higher interest rate on your bond than you would on your credit card.
No.
Okay,
So is current more risky than non-current?
it depends. Okay, we'll discuss it just now. There's pros and cons to both. Okay, so choose one and give me a pro or a con. Which one do you want to discuss first?
Current liabilities are creditors.
The?
Creditors.
Fine. Okay, so what about the creditors?
You owe money.
Okay, you owe money to them.
Yeah.
What else?
And you might not pay the money back to them.
Okay, perhaps. What else?
Interest.
Yes. Okay, so interest is applicable. Do you agree?
Yes.
Okay, so if interest is applicable on a creditor, okay, or can the creditor come back and take anything from the business?
Yes.
Well, not really. Okay, because what happens if you've bought, let's say you've bought, I don't know, let's say food, okay, water, cold drink, whatever the case might be. Okay, and let's say you're going to be using that, okay, to be generating income, i.e., you're running a tuck shop. Let's say you're running that little tuck shop here on campus. Okay, so if the creditor, so if their supplier gave them cold drink to sell, okay, does the supplier want that back?
Don't want some money.
No, yeah, they don't want that back. Why?
Because it's not going to do anything for the result.
Besides that, it's perishable.
Yeah.
Okay, it's not going to last a very long time. Okay, so would they want to take back the chips and sweets and cold drink? No. Okay, so is that secured or unsecured?
Unsecured.
It's unsecured. Think about your credit card. Okay, if you spend money on your credit card, can the bank come back and take items that you've bought? Let's say you've gone on holiday.
Yeah, no, they can't.
They can't. Okay, so this is unsecured or secured?
Unsecured.
And this is?
Secured.
Yes. Can they take back the house? Yes. Can they take back the car? It's secured because the asset is part of the agreement. Okay, you're using the bond to buy property. You're using the loan to buy a vehicle. Okay, can they repossess the car and the house? Yes, they can. And that's considered collateral. Okay, so will they give you a higher or lower rate?
Lower.
They'll give you a lower rate here. Why?
Because it's over a longer.
It's over a longer period as well, sure. And also there's collateral here. There's no collateral there. Okay, this is a short-term liability. Okay. Alright, so those are some of the points that you could have mentioned. Okay, so just to highlight one or two of them. Is there collateral? Yes, there is. Okay, so is non-current more or less risky? It's less risky. Okay, because you have collateral. Okay. What happens with the term? The term. The one is longer, the one is shorter. So which is more risky?
The current.
No, the long term. Why is the long term considered more risky than the short term in terms of time?
Because it's not yours yet.
Besides that, what happens over time? Things can change. Okay, so longer term, the obligation is prolonged. Okay, so a lot can happen over a long period of time. Not a lot can happen over a short period of time, exactly. Okay, and then if we're looking at less risky, in terms of lower interest rates, we spoke about that.
Yeah.
Why does long-term debt carry a low interest rate?
Because it's over a longer period of time.
And it's secured. It's got collateral, correct. Okay, it's got security. Okay. All right, and then higher risk in terms of changing rates. Okay, why is there a higher risk of rates changing for the long term and not the short term?
It's over a long period of time, so
Exactly.
things change.
Exactly. Okay, so you've done quite a lot of economics.
Yeah.
So you know inflation and how that affects interest rates. Okay, and rates change obviously over a long period of time. Okay, good. All right, so is there a better type of credit?
Is there a better type of credit? No.
What's important? No, credit is good. You have to manage it.
Yeah, but some people don't know.
Some people don't know how. Okay, that's a good point. Okay, so what's your view then?
No, obviously I
Do you like credit?
Yeah, because you can buy things.
Okay.
I don't choose credit though.
Do you manage credit? Okay, you don't use credit.
No, I don't use credit. I don't need to.
You don't need to. Okay, but would you?
Yes.
You would.
Yeah, but I manage it.
You'd manage
You can't
it.
overspend if you're not earning that much.
Okay, so you're focusing on what?
How much you earn.
Besides that,
Managing it.
yes. And how would you do that?
By
How?
limiting the amount you use.
Okay, yes, good. So having a level of control, okay, or let's say oversight in terms of your finances. Okay, but credit is good. Okay, so credit can be done or not can be used to do a lot of good things as well. Okay, in terms of financing the purchase of a house, a car, etc. Okay. All right, so long-term obligations is what we're looking at here. Okay, do long-term obligations have bad consequences? Yes. Okay, and that's why longer-term liabilities are more important to manage. Okay, because can you imagine not paying your bond? You're not going to be able to live in a house. Okay, if you can't pay for the car,
You won't be able to drive.
you won't be able to drive. All right, what other long-term liabilities? That's probably the biggest ones, okay, in terms of the consequences. So a business also needs to do the same thing. Okay, a business needs to pay the equipment. Okay, think about the machinery. If they don't pay the loans on the machinery, no machine. Okay, and if we don't have a machine, we can't manufacture. Okay. All right, accounting recognition. Okay, so if these obligations are not met, what happens? There's going to be repossession. There's going to be insolvency. Okay, so what does the accounting recognition do? The accounting recognition looks at the liability when what exists. What must exist for an obligation to arise? A contract. Okay, there needs to be an obligation. There needs some sort of, let's say, binding, okay, or an agreement. Binding agreement, okay, between two parties. Right, so one party promises to do something. Okay. Right, so recognition and measurement must be accurately reflecting the true value. Okay, we know true value is quite difficult to manage because think about property, plant, and equipment. What's the true value of property, plant, and equipment? Well, it's the carrying value, exactly. Okay, so the true value will be what it's actually worth. Okay, so what value do we use? We use cost, realizable, or current. Okay, what are those three representing? It's representing the true value that you currently have. Okay, so is a loan always going to be X?
No, because it changes over time.
How does it change?
Interest rate.
Increase or decrease?
Increase. Anything decrease.
Well, it increases when what?
Interest increases.
No. Increases when what?
When you take up more of the loan.
It increases when you get charged interest. And it decreases when you pay it off. Exactly. Okay, is that right?
Yeah, that's good.
Okay. All right, so you're debiting the expense or the asset when you're using credit. Okay, the liability will then be credited. So either the short-term or long-term loan will be affected. Okay, short-term if it's credit card, bank overdraft, creditors. Long-term if it's bond, long-term loan. Vehicle asset finance, yes, also would be considered long-term. Okay, yes. Okay, and the rule stays the same. Debit minus credit plus. Okay, and then just a note over here in terms of disclosure. Are these liabilities important?
Are liabilities important?
Yeah, borrowing and mortgages especially.
Yes.
Why? What do companies use borrowing and mortgages for?
They borrow money in order to pay off their machinery and that, because they might not have the money straight away.
Okay, it's to purchase those machines and equipment and land and buildings. Okay, so do companies need those assets?
Yes.
And what are those assets called? Tangible, intangible?
Tangible.
Tangible. And are they productive?
Yes.
They should be. Okay, so capacity is key here. Okay, so liabilities are important because it allows us to grow our capacity. Okay, so you don't have to have a lot of machines. Okay, you are going to then be able to finance them. Okay, or you don't need a lot of land and buildings. Okay, you can take out a loan in order to finance those assets to increase capacity. And with increased capacity comes increased income. Okay, because now if you've got instead of having, let's say, instead of having one machine, you've got two machines. You could be producing twice as much goods and making twice as much sales, depending on the situation. Okay, so what do the accountants want to see? They want to see detail. They want to see good disclosure. Okay, remember disclosure, definition for disclosure would be the format. Okay, the way we present information. Okay, and where will the disclosure be? Yes, exactly. Okay, because this is looking at the detail. Okay, good. Okay, so you could have a note where you've got all the information. So how long is the loan? How much interest do you pay, etc. Okay. Right, the category of financial instrument, interest rates and due dates, the amount of the installment, security, is there collateral, isn't there collateral? There could be a whole host of different details that you would disclose for your users. Right, and then just a note over here about debentures. What is a debenture? It's a loan, but it's similar to shares because you're splitting the big loan into smaller loans. So lots of people can, yes, okay, grant you those loans. Okay, so think about it. How easy or difficult will it be, okay, to raise 1 billion rand, okay, from one provider? Very difficult. But could we get maybe 1,000 million rand loans?
Yeah.
It's easier, right?
Yeah.
Okay, so that's what you're looking at here. You're looking at a debenture. Okay, where they're taking a loan and they're splitting it into units. Okay, they split it into small units so that people would be more willing to grant those loans. Okay, because as I said, it's difficult to get one big loan from one financier. Okay, it's easier to get many small loans from different parties.
Don't the government use them?
Governments use government bonds. They can use debentures as well. Okay, it's just an instrument that the banks will assist all parties with. Okay, municipalities, it could be companies, it could be government, it could be anything really. Right, as long as you've got some sort of cash flow to pay back the loans. Right, so if I hold 200,000 rand worth of debentures, and each debenture is worth 100 rand, how many units will I have?
2,000.
Yes, correct. Okay, 2,000 units of 100 rand debentures. Okay, so getting 100 rand from 2,000 people would be easier than getting
200,000 from one person.
200,000 from one person, exactly. Okay. Right, so with any non-current liability, disclosure is key. Right, please, as I said, look at the format and appreciate what the statements look like. Okay, you are going to have to draw up statements, so you should be looking at those statements in terms of their layout and formats. Okay. Alright, so I'm putting a note here in terms of disclosure. Where would I put the interest and finance costs? In the statement of comprehensive income. Why? Give me the why. Why will it go here?
Because it's an income.
No. We're looking at a liability. Liabilities don't give income.
Yeah, finance.
What is this? What type of account is this?
It's an interest and it's a liability.
No.
It's expense.
Yes. Okay, where do you disclose expenses?
Or it's a financial
Ooh.
position.
Statement of comprehensive income.
But why though?
Because it's performance, it relates to profit.
Okay.
Okay, remember what did we say earlier? Profit is what? Income minus expenses. Where do we disclose that? Statement of comprehensive income. Okay, or profit, loss, and other comprehensive income. Okay, so finance cost is what?
Sorry?
Finance cost is what? An expense.
Yeah.
All expenses go to the statement of comprehensive income. Okay, we'll summarize that on Friday. Okay, when we look at the disclosure. Okay, so on Friday we're going to start with the disclosure. We'll go through that long example that we had to skip back in chapter 7 because you couldn't do it then, okay, because you haven't looked at all the disclosure. Okay. All right, statement of financial position. What are disclosed there? The detail. Okay, so the loan would actually go to the statement of financial position because the loan is the liability. Okay, we know liabilities and assets give us the financial position. Okay. All right, and that's it. Now we can look at examples.